Japan Market Daily. The completed previous session kept Japan's equity rebound alive. The Nikkei 225 rose 1.201% to 68,557.73. That is the headline. But the session is more useful if we read it through three numbers. The first number is the Nikkei gain itself. A move of more than 1% shows that buyers were still willing to add Japan exposure after the prior rebound. The second number is dollar yen, near 162. The daily move was slightly toward yen's strength, but the level remains weak enough to keep intervention risk in the center of the market conversation. The third number is the US 10-year yield, around 4.57%. That keeps global rate pressure visible and makes the Bank of Japan discussion more important for equity valuations. Two forces drove the session. The first was global risk appetite. The S&P 500 also rose, so Japan was not rallying in isolation. Investors were still willing to own equities when global markets looked constructive. The second was policy tension. A weak yen can help exporters by increasing the value of overseas earnings. But once dollar yen stays around 162, the currency stops being a clean tailwind. It also becomes a policy risk signal. That is why the currency headlines mattered. The market is still trying to judge whether Japan's foreign exchange messaging is only verbal pressure, or whether officials are preparing the ground for stronger action. The inflation headline also mattered. Producer price pressure was described as rising at the fastest pace since 2023. That keeps the Bank of Japan rate hike path alive. Higher rates can support banks and insurers, but they can also raise the discount rate pressure on expensive growth shares. There was no single company-specific catalyst strong enough to define the session. The better lens is sector leadership. Exporters may still benefit from yen weakness. Financials may benefit if normalization improves lending margins and investment returns. Rate-sensitive growth shares face the harder test if yields remain firm. For overseas investors, the takeaway is straightforward. Japan remains attractive when global risk appetite is positive, but currency risk is part of the trade. A Nikkei rebound with dollar yen near 162 is not a simple risk-on signal. It is a risk-on signal with policy risk inside it. Three checkpoints come next. First, can the Nikkei hold the latest close? Second, can dollar yen move away from the intervention zone without actual action? Third, do Bank of Japan expectations keep rising after producer price pressure? If equities rise while the yen stabilizes, the rebound looks healthier. If the yen weakens again and policy warnings intensify, the rally becomes more fragile.